Yo, yo, yo. Good morning. Kind of. Yo, yo, yo. Good morning. We stream on the background. Yo. Good morning. A little later today. Fridays I'm gonna just kind of start whenever. But today we got Coreweave Ipo. Coreweave Ipo. We got and then we're gonna look into stable coins. I did a little prep for some stablecoin stuff, and it's kind of one of those things where it's like I thought I did a good amount of research, and then like when I look into it, it's like a lot deeper than I thought. So yeah, I might be stablecoin pilled now. But let's start with the Coreweave IPO. It did not perform as expected. We'll just say that. And it sucks because I also think the environment they're IPOing in is a very shitty time in the stock market and financial markets right now. But I also think a lot of it is it is a risky investment. They have a lot of debt. Microsoft is their primary revenue driver. It's a competitive market now. Yeah, I think just all things considered that investors have a much more bearish appetite, so to speak. So Coreweave priced IPO at $40 a share, below expected range. Now I can't find, it's not like a ticker yet or anything. Like I can't find it anywhere. Here it is on NASDAQ. I had it on TradingView, but even TradingView didn't have anything. It's just blank. There's no data yet, so it'll show up a little later. But Nvidia is actually like a big anchor. They invested more in Coreweave, but obviously they probably want to. So Coreweave on Thursday said it priced its share at $40 in the company's IPO, raising $1.5 billion in the biggest U.S. tech offering since 2021. And to me, it just doesn't seem that big, especially considering that they were going to price it much higher. So yeah. Okay, the company provides access to NVIDIA graphics cards for artificial intelligence training workloads. Had planned to sell shares between $47 and $55 each. At the top end of the range, that would value Coreweave's at 26.5 billion based on Class A and B shares outstanding. Coreweave shares are set to start trading on the Nasdaq Friday under symbol Coreweave. This was written. Oh, okay. Yeah. Here we go. Okay. Sorry, wrong article. That was today. This one is this is today. That was yesterday. But the context matters, I guess. Yeah, the IPO is a major test for startups and the venture capital market for an extended lull in new offerings dating back to the beginning of 2022 when soaring inflation, rising interest rates pushed investors out of risky assets. Other tech-related companies that have filed to go public in recent weeks include digital health startup Hinge Health, online lender Klarna, and ticketing marketplace StubHub. Oh, I didn't know StubHub. Bloomberg reported Wednesday that the chat app maker Discord is working on an IPO. Yeah, and we briefly looked at that, but there hasn't been information. We'll be following this, though. Yeah, Coreweave counts Microsoft as its biggest customer by far. Other clients include Meta, IBM, and Cohere. Cohere is an AI company. Revenue soared more than 700% last year to $2 billion, but the company recorded a net loss of $863 million. Coreweave's model is capital intensive, requiring hefty purchases of equipment and expenditures on real estate, for data center wise. And they, because it's capital intensive, they've been borrowing against their GPU. So their GPU is used as collateral. And yesterday we kind of noted that, Microsoft, like big tech, cycles out data center tech every 5 to 6 years. And so their GPUs that they're borrowing against will slowly, go down in money or go down in value. And I imagine in the future that's just going to be a problem, especially considering they're borrowing against it. And they, if they don't pay their debt back within the time that the equipment is valuable. And also their debt has 11% interest and it's come due here pretty soon. Because they've now priced it much lower and they've only raised about $1.5 billion, they need to use $1 billion of that to pay down debt. And so they really didn't actually get much more than they were really hoping. So, and to me, it seems like they're really banking on this to expand and help the business grow. It would be weird to raise money as a public company. I don't even know if you could do that, I guess. So this is today. Coreweave CEO says lower IPO price was where the buying interest was. Coreweave CEO Mike Intrater said Friday that the company's IPO pricing came below expectations, has to be placed in the larger context of the macro environment. Bro. I mean, he's not wrong, but yeah. There's a lot of headwinds in the macro, Intrater said on CNBC Squawk Box, and we definitely had to scale or right size the transaction for where the buying interest was. The company which provides access to NVIDIA GPUs, blah, 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 okay. You priced its IPO at $40 a share, below the initial $47 to $55 per share filing. The stock was beginning trading on NASDAQ under the symbol CRWV. The lower price provided enough of a discount to the replacement value that investors could feel comfortable buying. Sources familiar with the offering told CNBC Leslie Picker. Replacement value is the value of the company's assets at the present time. Yeah, because I just think it is a little risky, and they did have the default we covered, the kind of quote unquote administrative default with Blackstone. Some of they blended some money. Some people just said it's whatever, just admin error. Other people said that it's a sign to not invest. I think it's, even if it's an admin error, it's an error nonetheless. I just think this company's their finances are just not the best. That's just kind of what it seems like. And I think it seems like other people kind of maybe just don't. Yeah, just it was too pricey at this for $7.55. About 10 to 15 long only and strategic investors made up the majority of the backing group. Long only. Yeah. You'd have to go long with this because they're not going to probably... market's going to be turbulent these next few years, especially as they're figuring their finances out. We believe that that as a public market gets to know us, get to know how we execute, and get to know how we build our infrastructure, get to know how we build our client relationships and the incredible capacity for solutions, the company will be very successful. NVIDIA is anchoring the deal with a $250 million order. Yeah, so NVIDIA invested a $250 million, and they already own like a 5% share. Coreweave raised $1.5 billion at $40 a share, giving it a non-diluted valuation of around $19 billion. Yeah, so they raised $1.5 billion, and yeah, okay, they talk about right here. He says, Intrader said the company will use the money to pay down debt and for expansion. But, you know, they not that much now. The company's held nearly $8 billion in debt at the end of 2024. Coreweave also bolstered the recent market action triggered by DeepSeek, which pushed the company to build bigger, build faster. He also addressed the administrative issues with a loan last year in which the company faced technical defaults. Oh yeah, this is the kind of default thing. And the company started to use money from the $7.6 billion loan for scaling in Europe. Okay, wow. All right, let's watch. I have a few videos we'll watch here.
Yesterday, during our conversation, I raised a lot of concerns amongst potential investors in the Coreweave IPO. Remember, the range was 47 to as high as, let's call it 53. We spoke earlier this morning about the fact that it certainly doesn't seem to be the case. And now Leslie Picker joins us. She's on the phone. She has some new reporting and details on where we may see this thing get priced. And I would point out, Leslie, as you well know, obviously following this, we'll have to wait and see because we won't know till later. But I know you have some important information for us. Please.
No, you're right, David. But the price is not official until that final pricing call.
Oops. Sorry.
After the bell. However, in speaking with a source familiar with this deal, I am told that NVIDIA is planning to anchor it at $40 a share with a $250 million order. So that's why you're hearing that $40 a share price floating around. That's the conversation that investors are having with the banks as it pertains to kind of where this is pricing and where they feel comfortable. I am told that they're not refiling. They're not officially downsizing at this point in time. This is just based on conversations with investors and, of course, that anchor arrangement that they have.
Yeah, and that's if we look on Nasdaq's website, it still says 47 to 55. Maybe that's like what they filed it at. But usually, I feel like the people who are like the first to invest, or like invest in the IPO, they kind of get a cheaper deal, and then they like, you know, when it goes to the general public, it's you know, a little bit higher price. That seems like what it how it kind of works, but I don't know. Sorry, I just realized, like, what has Reddit stock been doing? Fuck. Down 5% today? Yeah, bro. Just sold here. Okay.
With NVIDIA at $40 per share. NVIDIA already owns about 6% of Coreweave, so they are already an investor here, already a customer as well. But this is, you know, a step in what's become an expected smaller IPO than they initially had filed. Of course, the range that they have on file at this point in time is $47 to $55 per share. So at $40 per share, that would be well below that. But again, this is just where NVIDIA is anchoring. This is not the final price of the IPO, guys.
Right, and as you point out, they own roughly 6% of the company, and obviously Coreweave is an important customer. In fact, their access to NVIDIA chips perhaps is one of the more important moats that they have in some ways, given what they bring into the data center for their hyperscaler clients is obviously a lot of those GPUs and then connecting them all and the cooling systems. Leslie, when do we think we're going to get a better sense here in terms of, you know, where this thing is going to ultimately... By the way, how many shares are we talking about? Can we just tell everybody what the expectation was in terms of what they're able to raise? You got a lot of selling stockholders here as well, so it's not all just pure proceeds, obviously.
Exactly. So this is most of it is primary from the company. 47 million is from the company, but 49 million is the total number of shares that will be offered in this deal. At least that's what's on file. Now, if it is downsized, it could be less than that if they're not able to fill the order book for the full 49 million shares at a price that they're comfortable with.
Yeah, I think that's what happened.
The deal to be smaller, but currently what's on file is about 49 million shares of both primary as well as those selling stockholders that you mentioned.
Right. They have.
Okay. Let's check out the Coreweave. Yeah. Let's check out this, and then we'll watch the interview.
Next guest is the largest institutional investor in Coreweave. He is David Snyderman, Senior Managing Partner at Magnetar. Nice to have you here.
Well, thank you so much for having me.
And a great day to have you as well. Obviously, you got involved with this company some time ago. My understanding is, David, is that you, in fact, were also involved in the pivot from being a Bitcoin miner to obviously what we know today as this company. What gives you the confidence overall that this is going to be a success? Obviously, it's going to be a success for you guys, given where you invested so long ago. But more broadly speaking, for those who invest today.
You know, first, this is a really exciting day for Magnetar, for our investors, and especially for our partners at Coreweave. You know, maybe I should say Magnetar we approach investing through a debt investor's lens. And so that means we're very focused on the assets, the cash flows, and downside scenarios. And that's what originally drew us to Coreweave. And they're picks and shovels. They're the infrastructure for AI, right? And so
this is official $40. In 37, we just saw in the previous video where they said that it would be 49 million. So it looks like they lowered the offering size.
And so if you think about their product today, it's the essential product to make AI go. And so they are purpose-built for high-performance compute for AI workloads. And when you ask, like, why are we so confident today, we read all the same headlines that everyone else reads, that things are slowing down. But in this balance, we see the order book. And,
yeah, because that is important to know, is, like, they did have, they signed, like, a deal over 5 or 10 years with OpenAI for, like, $11 billion. They have, like, $15 billion on the books. So, like, they have money coming in. They have orders.
Anniversary at Magnetar this year. So this is the most demand we've ever seen in a company. They can't keep up with demand, and so for us, we're extremely confident that this will continue.
Yeah, and the CEO of the company obviously saying similar things this morning on Squawk Box. You mentioned, of course, your approach from the fixed income side. You are a large creditor to the company.
Yeah.
Can we talk about this? Are some of your loans are backed by the actual value of the GPUs? Is that correct?
That's correct. So all of our loans are, and so I think that's.
Okay. So they're actually a creditor. So this is actually an interesting perspective, because we've kind of been seeing how, like, they use their GPUs as collateral. So maybe we'll actually get some
value of the GPUs, is that correct?
That's correct. So all of our loans are. And so I think that's a misconception in the marketplace. People keep focusing on the debt of the company. But for us, we're so used to working in capital-intensive industries, where Magnetar's at its best is where we can help companies lower their cost of capital. So take a simple example.
But their cost of capital is mainly just from the debt, right? Like, I mean, I don't know. How can you lower the GPU prices? I'm sure, like, there's operational efficiencies, but, like, that's probably not that much when you compare it to this, like, buying the big purchases of, like, real estate GPUs. Their debt seems like it's expensive.
If you have an airplane manufacturer and the government gives you an order for an airplane and they're going to pay you $100 and it costs $50 to build it, you take that contract to the bank, you say I need to borrow $50, they put the contract against it. When you deliver, you pay back the loan. This is the same thing we did with GPUs.
But that's not the case, though. They have interest payments coming up. Like, it's not like it's as simple as that, I guess. Like, I don't know. He made it seem like it was just like, yeah, I don't know.
We took some of the best credits in the world, so Microsoft's in the news a lot to be a big customer. Yep. We took a Microsoft long-term contract to essentially the bank, to the markets, and said, how can we finance this contract? So I think the key point that people haven't really understood so far, at least from what we've seen in the
I see their strategy, but that definitely seems risky. It seems more risky. I mean, hence 11%. I don't know. I wish we knew what, like, corporate lending, like, for, like, high value lending, like, what the interest rates are.
Each one of those cash flows, the loan is it's exactly matched by cash flows.
Right. Okay. So, and over the time of the actual contract,
I see.
guess, as well. But the concern has been among some investors the depreciation schedule. You had Jensen Huang last week saying Hopper's going to be worthless, basically. Now he kind of.
Oh yeah, and thank goodness, man. They're hitting all the points that we had. Yeah, the depreciation, because, like, if their GPUs depreciate and then they're borrowed a certain amount against those, and the GPUs aren't as valuable as they were when they had the loan, then the collateral isn't enough now, and so they kind of need to make that out, or, like, cycle that out. How do they? Most of their inventory, I imagine, right now is Hopper too, because that they're still kind of getting the Blackwell series rolled out, or, like, built, or they're just not that many yet. They just only got released. So yeah, that was my concern.
Back a little bit, but people wonder whether they have to come up with more collateral if in fact you're going to be depreciating the value of these GPUs more quickly, because 2 years from now they're not worth anything.
Yep.
Yeah, so that's not how these contracts work, right? The way that's a misunderstanding, I think, in the marketplace.
Because the money's coming from Microsoft.
The money's coming from Microsoft, and the way these work is it amortizes down quite quickly with the contract. So there's a depreciation schedule, and there's the amount of cash flow coming from the counterparty. The loan itself amortizes down each time they pay, so you can never get in a situation where you don't have enough collateral for the loan.
What is the average life of the contract?
I think they just reported in the S1. It's a little over 4 years.
And are your
That it still seems contradictory to what we've read with, like, their interest payments coming up and things, like, with their debt. I don't know.
Expectations of Microsoft will be there in 27 and 28, particularly given their 62% of revenues, at least as of last year, I believe it was.
Yes.
And there have been many reports about them pulling back in certain areas.
Sure.
Yeah, and again, we covered that yesterday too, because it seems like that Coreweave might have been grouped in with, like, something with, like, them Microsoft cutting back a data center spend in their 62% of their business, like. But it seemed like, though, what we read from the Register was it was more so where data centers that couldn't fit or didn't have requirements to fit the new NVIDIA GPUs because they're special. They use a lot more power and they need more cooling, like water cooling. So they need special requirements to put them in data centers. And so if they can't fit those, then they just kind of canceled it. That's what it seemed like. So we don't know if Coreweave is part of that, but.
Better question for Coreweave themselves. I think what we're seeing is just customer demand in general. And so if you think about starting with the hyperscaler demand and going to more corporate demand builds over time. They build products, they get used to those products, and they grow and they grow and they grow. We're just seeing that. We're seeing that growth.
What's the competitive mode here, though?
So it's funny. Everyone talks about reliability.
30,000 GPUs, mind you. This is Microsoft has at least 400,000. Like most big tech has at least like 400,000 GPUs. We read that few months ago. I don't know what now with the Blackwell, but yeah.
Reliability and skill is the competitive moat, but I don't think a lot of people put any substance around saying reliability. So I'll give you a quick example. When you go to train a model, you train for 20 minutes, and you save again. If at any time in that 20-minute span it fails or breaks, you go back. Compute's really expensive, but that's not the most expensive piece. The most expensive piece is the compounding effect of not getting your product out to market. Coreweave and their management team, they are the best at having reliable, large clusters in the marketplace. We've been investors for 4 years now. We know they're the gold standard. I think what this IPO does is it brings it to the marketplace, so people have the chance to really understand the company's story.
I want to talk about the interest. Yeah, look at the comments here. Yeah, I mean the fact that they people are misunderstanding something that should be kind of simple. I think that's kind of the indicator. It's like if you're doing some new financial strategy, it's always kind of, I don't know, they're always sus. Yeah. This is an interesting. This is asking to be this is either a person who wants to scam someone or someone asking to be scammed. Okay, let's look at the Coreweave CEO
interview. Going public today on the Nasdaq.
4 hours ago.
The biggest U.S. tech offering since 2021. The company priced the IPO at $40 a share. That was below its expected range. It's going to be trading later today under the ticker symbol CRWV. And joining us right now, first on CNBC, right here on set, is Coreweave's co-founder and CEO, Mike Trader. And Mike, thank you for being with us today.
Thank you so much for having me. I'm really excited for the day. I'm really excited for Coreweave and looking forward to speaking to your audience.
I know this is a really big deal for you all. Based in Livingston, New Jersey, you all have come a long way from what you started out.
What is going on in the background? I know it's New York, but bro. These markets and shit.
Building out databases, and you started doing that for Bitcoin mining and other operations. You jumped on the AI trend, and you were there early, and you got to these data centers and are building them out at an incredible pace. Building up revenue at amazing, phenomenal speeds. I think revenue growth of more than 725% for the last year. But you're also taking on a lot of debt to do it. And the IPO that came out is the biggest tech IPO since 2021, but it was below expectations. What happened when you were out there on the roadshow selling this?
Yeah. So look, it's clearly a tough take, right? There's a lot of headwinds in the macro. There are headwinds in the AI trade, and we definitely had to scale or right size the transaction for where the buy interest was.
Bro, the way he's speaking is so crazy. Bro, he has to. I don't know if he's the language he's using is just very trying to navigate around.
This is going to be a very, very exciting transaction for us. It does an enormous amount to move the company forward. It positions us for the next stage of growth for Coreweave, and this is just an incredibly fantastic time to begin that journey. Going public is just a day in the life of an incredibly long-term transaction and business that we're building.
You're raising about $1.5 billion. I think expectations at the high end would be that it could be as much as $3 billion. Still, $1.5 billion is a big chunk of change. I think about $1 billion of that is slated to pay down debt. Is that the case?
Yeah. So we're gonna pull in the $1.5 billion later today. It's very exciting, and then we're going to use that to pay down some debt. We're going to use that to continue to expand our footprint, to invest in human resources, to build business and continue to scale it at what has been an absolutely unbelievable pace over the past several years.
Yeah.
It's really exciting.
The pace has been breakneck. It has been phenomenal to watch, but there have been questions that have been raised this year by what we heard from DeepSeek earlier this year about whether all of these companies will continue to spend at the same pace, whether they're still going to need the same computing power. What do you say to investors who are looking at this and have some of those questions?
DeepSeek was one of the most amazing dislocations that I've ever seen, right? From the perspective of...
It's 2 times this, bro.
DeepSeek triggered a betting, right? But on our side of the table, on the compute side of the table, where the rubber hits the road, there were only 2 things that actually happened. There was a massive spike for spot computing costs. And then there was... my phone just blew up, and it was all of my clients.
Oh, I just got a Wall Street Journal breaking news. And is Coreweave like actually on the market now? Can we see it? CRWV. Oh yeah, here we go. We're live. 39. It's immediately down. Trading, I don't know if trading is held still. Okay, I know you showed me this 20 times. All right, we're live. So, okay, so what this tells me is that people who bought it are selling lower. Or, I don't know, actually. What does it mean when an IPO goes immediately down? Okay, let's see. It's like just it's continuing to go down. Okay, let's see the Wall Street Journal article. Honestly, though, this is kind of a sleeper interview, let's be real. Bro, that's crazy. Holy shit. AI Center cools demand for hotly anticipated Coreweave IPO. Now Coreweave's stock market debut is turning into a high-profile stumble for both the AI industry and new logos. I think though them putting this on the AI industry, yeah, I think. Yeah, I hope that Coreweave's IPO isn't a indicator, bellwether, whatever term they want to use for the industry, because I really think Coreweave's business is a little sus. You know, they just not sus, but they do it. They're running it in a different way, borrowing lots of money, using their GPUs as collateral. We just watched an interview with the Magnetar CEO, and he had a clear explanation for the debt and how it works, but ultimately the investors seem to maybe not think so. You know, it's like, okay, we're finally trading, we're now at 38. It seems to me, it just seems like the company is more so suspicious or not a value, and you know, not a good it's not attractive to investors, not necessarily the industry as a whole. It's like demand is slowing. You know, we're just getting NVIDIA GPUs coming, the new NVIDIA GPUs coming. OpenAI's, we literally just had like a viral moment with their, you know, Studio Ghibli moment, whatever, where people are, you know, using their new 4.0 image generation. And Sam Altman tweeted saying that our GPUs are on fire. We have to put rate limits like that. You know, that doesn't seem like slowing demand. To me, it seems like Coreweave is just not the most attractive company to investors, and it's not ran in a way that people are jumping at the bit to invest in it. And their lower IPO price, I think, says that, not that the AI industry is stumbling. I don't know. Yeah, it's offering at $40 a share, well below the $47 range. Friday, Coreweave opened for trading even lower at $39 and was trading around that price in its early moments. The stock is listed on Nasdaq's stock exchange under the symbol CRWV. Investors pushed back on the price tag during Coreweave's IPO roadshow, citing the company's high costs and debt load. The uncertainty echoes concerns many hold about the sustainability of the AI boom, which the biggest companies are spending hundreds of billions of dollars. Yeah, the IPO market's slow. Yeah. Cool. Okay. Yeah, it just keeps going down. It's already down 5%. I don't know if trading's actually held or if it's just saying that. I wish the news would be like about Coreweave. Is it being held? I can't tell. Bro, stop showing me this. So it looks like people are just like, the sell is. Yeah. Rip. Wish they talked more about the debt interest, but okay. Let's change gears and let's look at stable coins. Also, they said this in this video, they said Rocket Lab takes off, and I was like, bro, what? Takes off means up like 1%. I was like, okay, guys, like. It's not even up 1% yet. Like, relax. Looks like the market's not doing too hot today. Oh, down 4 and 5%. All right, let's change gears to stable coins. Okay. So, we've seen stablecoins in the news. We've covered it here on stream. We looked at ARK Invest, Big Ideas 2025. Stablecoins was a part of their, big ideas. They think there's a future there. And I kind of became stablecoin pilled in a way because I do get the utility of it, and I actually think it's one of the better things that you could pair with blockchain instead of the more volatile like general cryptocurrency or like like Bitcoin or Ethereum or whatever. Especially if you just want to use blockchain to move money or something, or you just use it in a financial sense, stablecoins just provide a stable way to do that where you could hold money in cryptocurrency that isn't as volatile. It's not going to go up and down. And generally it's backed by in a few different ways. It can be backed by in a few different ways, but it's usually backed 1-to-1. Now, I still think that's, I need to see, the books to like believe that they're actually doing that. But yeah, okay, yeah, so there's a few different kinds of stable coins. I actually didn't see this commodity one, but that makes sense. But essentially, they're always backed by something, because they need to be able to keep it stable in a way, and they need to have something in the bank, so when someone buys it and then sells it, they have the money to do that. And it seems like that's really what it's used for. It's used for like moving money. using blockchain to, you know, or smart contracts. Those are kind of the benefits of it. Yeah, so I think really the benefits. Well, let me open up a better source. The benefits. I'm trying to find the source that I had. Okay, here we go. Let's just get Coinbase. Yeah, really the benefits are moving money quickly, because if you think about moving stablecoins are good for moving money quickly, because if you think about the like general more, you know, traditional banking system, it takes a while to move money unless you're doing like wire transfers, but wire transfers usually cost money and are expensive. Generally with crypto, it's a lot cheaper. The fees are lower. You can use stable coins to move money quicker and without the volatility of using like a Bitcoin or Ethereum, Solana, whatever. And I think though something that is underestimated is the programmability of it, because you could pair it with smart contracts. So you could have, you know, you could use blockchain with, you know, in smart contracts to ensure something happens before the you know someone gets paid out. And so that's kind of the programmability around it, is where it's like you could have certain triggers that when, you know, the smart contract triggers, it could pay out something. And I think about it like a transaction. So like, you know, with smart contracts, once this, you know, the buyer or seller does something, then, you know, you could get the money. I think that is actually a huge benefit of it. And I didn't really like understand, you know, like where smart contracts could be, you know, valuable in the sense that like you have to like, you know, use a volatile cryptocurrency behind it. I think that was always like the downside, but now that you could pair that with stable coins, like it seems like it's a lot more viable for everyday people to use potentially. Okay, so yeah, there's a few types. There's the typical one. It seems like it's fiat backed. Fiat backed crypto stablecoin. So it's backed by US dollar or just, you know, a normal fiat currency, just a normal currency. I'm sure there's ones with yen, you know, euro. It's just backed by some sort of traditional dollar. And then they have reserves, they have collateral, which I think that's kind of what stabilizes the price though. You know, such reserves are maintained by independent custodians and are regularly audited, something that should be considered cautiously. Tether, USDT, and True USD, TUSD, are popular stablecoins backed by US dollar services and denominated at parity to the dollar. As of late June 2024, Tether was the third largest cryptocurrency by market cap, worth 112 billion. Yeah, and Tether's like the big one. Let's look at Tether as a let's look at Tether like as the company. Oh, we just dropped. Yeah, let's look at how it works. Tether tokens are assets that move across blockchain just as easily as other digital currencies, but are pegged to real world currencies on a one-to-one basis. Tether tokens are referred to as stablecoins because they offer price stability as they are pegged to fiat currency. This offers traders, merchants, and funds a low volatility solution when exiting positions in the market. Now, I think the market they primarily mean is cryptocurrency. And I'm actually don't even care about like the actual like within the crypto ecosystem, because realistically that doesn't, most people, I feel like don't value from that. I'm talking about stable coins when you could use it in the more traditional finance sense or the everyday person until we get more mass adoption of cryptocurrency like every day. So like, yeah, that was one of the things when I was like researching. I was like, I don't care about like within the crypto market really, because you know, it's not, I don't, unless you're trading like day trading Bitcoin, like this, it like you would never really like need to use this unless you just want to hold it. But if you're just holding it for the yield, then I feel like that's more just like a traditional investment type. And that's kind of what we'll get into. All Tether tokens are pegged at a 1-to-1 with a matching fiat currency. One Tether is one USD and are backed 100% by Tether's reserves. As a fully transparent company, we publish a record of our current reserve assets. Yeah, I just feel like there was a like drama around Tether though. Tether tokens offer exceptional liquidity on a tier 1 exchanges, giving traders the ability to take advantage of arbitrage opportunities in the fastest time possible. Yeah. Bro, look at this, bro. 144 billion in circulation. This is euro. This is Chinese. Australian. Yeah, they have a lot. So here we go. So they have they're on like every blockchain. Or like every network, I should say. I don't know what the official term is. So what it seems like it is when you buy one Tether, they put $1 in the bank account. That $1 in the bank account, they probably buy traditional bonds or something similar with that money and make the difference. I just want to know how they make money. Is interest earned from the reserve asset that's backed by the stablecoin? Yeah. The user reserves can include traditional currencies, cash equivalents, and other assets. Tether holds a mix of these assets to maintain the peg US dollar. A portion of the reserve assets for short-term lending and investing. Interest earned from these activities. Yeah. One of the primary sources of income for Tether is the interest earned on the reserve assets that back stablecoin. Yeah, and so I think, I don't know if Tether, USDC, like... Do you own, do you get interest on this? Yield. So 11%? Like, so CFI, DeFi? So you could stake it, lend it, and then this I imagine you just get it from holding. Like, let's just look at this. So locks 16%? Like, how? Earn up to 14% annual interest with flexible savings, while keeping your funds accessible for investing or trading, or open to 16% annual interest with fixed term savings by locking your assets for a set period, maximizing returns. That's like... the only way I feel like they could do this is, especially if it's backed by more traditional currency, is like they have some like algorithmic trading that they use with your money to like trade, and they just make insane like interest. I don't really know how else they would be able to pay that unless they're just losing money. Like, you earn this interest by automatically, and your assets are always available to borrow against and exchange. If earn nexo is disabled, the interest you receive is paid out in kind. You earn bonus interest once you choose this option from your account. All interest you earn interest. Bro, like what? Like, this was but just see what the highest one is. Okay, let's just go this. Even if you have like like, I don't get it. Yeah, I like, this is like what makes me just a little suspicious. It's just hard to like, it seems too good to be true. That's like the feeling. Puts us perplexity. How do some stable coins offer such high interest yield when compared to something like a normal savings account? How does the company make money? It seems Alright, let's let that run. Okay, so let's look at other stablecoins. Actually, let's look at the there's been failures. Actually, okay, sorry, we're jumping around. We need to look at the other kinds of stable cryptocurrencies first. So we have the fiat backed, and now commodity backed, and essentially they're backed by, you know, anything. But commodity backed stablecoins that peg to the market value, such as gold, silver, or oil. Yeah, they hold the commodity using third-party custodians or by investing in instruments that hold them. One of the most popular cryptocurrencies, popular commodity-backed tokens is Tether Gold, which we actually saw on the Tether website. But now we have crypto collateralized. Now, these ones generally they're backed by a reserve of cryptocurrency. But because they're more traditional cryptocurrency, not stable coins, are like Bitcoin is more volatile, they generally have to hold, they over collateralize because they need to have more just in case the price goes down. Cryptocurrencies worth $2 million might be held in a reserve to issue $1 million in crypto-backed stablecoin, ensuring against a 50% decline in price of the reserve cryptocurrency. For example, MakerDAO's DAI, and DAI is one of the early and big ones. Stablecoin pegged to the US dollar, but is backed by Ethereum and other cryptocurrencies worth about 155% of the DAI stablecoin in circulation. Now we get the algorithmic stablecoins, and these ones are where things like are sus, because previously this is where they have failed. Stablecoins have failed, where they are not worth the fiat currency or whatever they're backed by tied to, because algorithmic stablecoins don't have any reserve. Their primary distinction is the strategy of keeping the stablecoin's value stable by controlling its supply through an algorithm, essentially a computer program running a preset formula. Some ways that's not so different from central banks, and that's a good point, which also don't rely on a reserve asset to keep the value of the currency they issued stable. The difference is that the central banks, like the US Federal Reserve, set monetary policy publicized based on well-understood parameters. Yeah, and status of issuer, legal tenders do wonders for the credibility of that policy. Yeah. The price of Terra. Yeah, and Terra's like the biggest to fail, I think. Algorithmic stablecoin plunged more than 60% on May 11, 2022, vaporizing its peg to the US dollar as the price of the related Luna token used to peg Terra slumped more than 80% overnight. Yeah, and that's the downside. And also one downside that it may or may not be a downside is the idea that cryptocurrency in general is a benefit is that it's decentralized, and stablecoins are in a way like not. They're very centralized. One company controls the minting, they control the collateral. It's just not. It kind of goes against some of what the being the benefits of crypto or being into crypto means. Take that what you will. I think that this is a good way to get the general public and just more general consumers and businesses and financial institutions using blockchain. And I think that seems like it's beneficial. That alone. Okay, let's look at some news. Oh, wait, let's look at some other failures here, because it seems like most or all the ones that have failed are generally algorithmic. Often dollar. Some of these though are just like does it even mean anything? So Alka USD 2022, a hacker took advantage of a bug on this liquidity pool, which resulted in 1.2 billion AUSD being minted without collateral. This event crashed the US pegged stablecoin to a penny. In response, the Alka team froze the erroneously minted tokens by placing the network in maintenance mode. Dang. After the CoinFlex yield platform halts withdrawal due to extreme market conditions last week and continued uncertainty. This is, involving counterparty FlexUSD, which is stablecoin. People could earn 18% interest on the CoinFlex platform collapses. Now, Deus Finance, like Deus Ex, market continues to mourn over the losses of Terra and Luna debacle. DEI stablecoin used as a collateral mechanism for third-party instruments built on the Phantom-based decentralized finance protocol, Deus Finance, failed to maintain its dollar peg, falling below 60 cents. But how? If it's pegged to the dollar, like, is it just because they didn't have collateral? Like, used a collateral mechanism for third-party instruments built on. So it seems like that's it. As the price of DI hit an all-time low of 52 cents, its market cap also followed, dropping from almost 100 million to around 52 million. However, despite the depegging of its stablecoin, Deus Finance's governance token DEUS went up before falling to 200. What the fuck? Okay, now we have Terra. Suffered some of the biggest weekly losses in recent months as prices fell 99.7 in a week. Lunar price fell 96%, pushing to less than 10 cents. Yeah. A change in market dynamics caused Luna prices to snap at breakneck speed. Luna plummeted through several support levels as Terra USD, a Terra issued stablecoin that meant to be priced at 1-to-1 peg US dollar, lost its peg. Yeah. Bro, this is another one. The stablecoin protocol saw its own governance proposal system exploited, enabling a malicious actor to extract all its $182 million in collateral. Credit-based stablecoin protocol Beanstalk Farms lost all its 102 million collaterals from a security breach, caused 2 sinister governance proposals in a flash loan attack. Wow. They asked for the protocol to donate funds to Ukraine. However, the proposals had a malicious writer attached to them that ultimately created the sinkhole of funds from the protocol, according to smart contract auditor BlockSec. Wow. There's been quite a few. So these are the oldest ones. New bits and stablecoin purchased through 2013 provided an illuminating case study for how stablecoins work in practice. It has been functional for over 3 years, ever since the beginning of the stablecoin concept, and currently the only live example of a stablecoin in the whatever this is. Nubits has suffered 2 big crashes and extended peg breaking. Fortunately for us, the value was okay. Dang. Okay, let's look at some news with because stablecoins have been in the news. So Wyoming said that they're gonna launch their own stablecoin. State of Wyoming is testing its stablecoin on multiple blockchains. State officials confirmed Wednesday. Why it matters? Yeah, because we covered the other day on stream how they are there's proposed laws that are that's bipartisan to pass stablecoins, essentially treating them more like a bank. Fidelity is launching a stablecoin, which we covered yesterday or the day before. PayPal is probably the first major brand of the game. Made news with stablecoin a little over a year ago. Fidelity is testing one. Custodia and Vantage Bank just issued one. Bank of America said it will likely get on it too. And World Liberty Financial, which is Trump's DeFi effort, that's supported by Trump organization, announced its own this week. Wyoming is notable in that it comes from domestic government, and the coin WYST, Wyoming stablecoin, would be a flex by a state that has long embraced the crypto industry. Wyoming is, even though they don't seem like it, they do have ties to the financial markets. That's where like Jackson Hole is. A lot of there's like financial meetings there. The Fed has their big meeting, like all the kind of like big financial people meet there. So I mean, I don't know. This isn't like super not in line. It seems like they embraced it before. Widening race to develop stablecoins is being driven by the expectation of lessening regulatory friction. But Wyoming Governor Mark Gordon yesterday said the state, which started this process with 2023 legislation, wants to be above all that. Yeah, he's speaking at the DC's blockchain summit, explained that he thought a conservative approach to a stablecoin makes sense. Everyone's seeing trillions of dollars coming their way. Everyone wants to kind of establish a new thing right now. I guess though, it's just like, what? To me, it seems like this is a state issuing like bonds or something. Like that's just kind of what it seems like. Everyone wants to be prudent with slightly over-collateralized backing and a strong commission to bring the token about. Profits from the coin will support the school system. The state published testnet addresses for the 7 blockchains where it's running. Test, Avalanche, Solana, Ethereum, Arbitrum, Optimism, Polygon, Base. Run distribution is working with Layer 0, the interoperability behind Stargate. The stablecoin will ultimately be multi-chain, but will start on just one. Wyoming's process ruffled some feathers. Charles Hoskinson, Wyoming's resident and founder of the Cardano blockchain, has expressed anger in that his chain didn't get a chance to make a bid to be part of the process. Perhaps this entire enterprise should have never happened in the beginning. Jeez. So far, stablecoins are a Coke and Pepsi situation. There's Tether, there's Tethers, there's Circles, and there's everyone else's. Yeah. Because these two are probably just have the market so much. This is January of last year. Yeah, it's interesting. I think it's interesting. I just don't understand. Let's actually check in on Perplexity, how these companies would give the high yield. Stablecoin issuers generate revenue through various methods. Interest on reserves. Issuers invest the collateral and asset backing stablecoins. Invest the collateral assets backing stablecoins, often in low-risk assets like treasury bills, generating substantial leads. Treasury bills are only getting like 4.2%. They're often like 20% interest. Like how? These are charged for minting, redeeming, or transferring stablecoins. Yeah, but this is very low. Stablecoin issuers offer loans to users who deposit their stablecoins as collateral, earning interest on these loans. This seems to be how they make money. Yield farming and liquidity mining. The DeFi space, stablecoins are used for yield farming and liquidity mining, generating high returns. And that's what it seems like the benefit of it right now. That's, I don't know. I'm kind of thinking about like throwing like $1,000 and like just use it to like yield farm and just try and get like the highest yield and see if I actually make money on it. That might be an interesting experiment. Factors contributing to high yields. Yeah, lower overhead costs. Stablecoins platforms have lower operational expenses compared to traditional banks. Yeah, I know this, but like still, like it can't be that much. High demand in DeFi. Decentralized finance platforms create significant demand for stablecoins, driving up interest rates. That doesn't make sense. Lack of regulatory constraints. Unlike traditional banks, stablecoin issuers may operate with fewer regulatory restrictions, allowing for more aggressive yield strategies. Yeah, and that's what I think. It's like it's more so like they have like algorithms and they're doing some sort of trading shit. Market competition. To attract users, platforms offer competitive rates, sometimes using stablecoins as loss leaders to promote other services. Okay, see, this would make sense. Risk considerations. Lack of insurance. Unlike bank accounts, stablecoin investments are typically not protected by government insurance. Yeah. Regulatory uncertainty. The regulatory landscape for stablecoins is still evolving, which could impact their operation and yields. Technical vulnerabilities or failures in the platforms or smart contract could lead to losses. Excuse me. Yeah, and this like governance we saw. Market volatility. Although stablecoins aim for price stability, they are not immune to market fluctuations. Yeah, collateralized commodity, crypto. See, the algorithmic one seems like they could offer the highest yield because they don't like need like that much collateral, and so like they could just like, yeah. By connecting borrowers with lenders, lenders deposit their stablecoins, which are then loaned out to borrowers. Interest rates can vary based on market demand and supply. It's hands-off approach where the platform manages loans and risk. Crypto banks or financial platforms offer savings accounts where stablecoins can earn high interest rates in traditional fiat savings. Yeah, lending, staking. Some blockchain networks, you can stake stablecoins to support network operations, earning reward in return. The process contributes to the security and efficacy of the blockchain. Yeah. Disadvantage. Advanced DeFi strategy involves lending or staking stablecoins in various protocols to earn rewards, often in the form of additional cryptocurrency. Yield farming can be complex and involve navigating multiple AI platforms. I don't know. This seems like it'd be like fun to figure out. Honestly, like it seems like a game. Why are stablecoin interest rates so high? Yeah. High demand DeFi platforms. Our major driver of demands for stablecoins. Decentralized finance, yeah. Stablecoins are widely used in these platforms for their stability and ease of transfer, leading in high demand and consequently higher interest rates for depositors. I don't understand how that... Okay, so like I guess what I'm seeing now is there's a high demand for stablecoins. So to loan your stablecoins, because there's high demand, you could offer a high interest rate. And people are willing to pay that to, like, you know, do whatever with the stablecoin. I guess that's kind of what it is. In DeFi space, users can earn returns through yield farming, liquidity mining, which often involves stablecoins. These activities can offer high yields, which are then passed on to users who lend their stablecoins to these platforms. Lack of insurance, high risk. Traditional bank deposits are often insured, like FDIC insurance in the US, which offers a safety net for depositors. Stablecoin deposits, on the other hand, do not always have such insurance and are exposed to various risks, including smart contract risk, regulatory risk, and platform risk. Compensating with this high risk, high interest rates are offered. I get that, but like ultimately it's the company behind it who's like fronting the cost. Like that's what I'm worried about. Operational cost of running blockchain-based platform service can be lower. Yeah. Cryptocurrency market is highly competitive, and platforms offer attractive interest rates on stablecoins that draw users and capital. This competition can drive interest rates, but it might be stable long term. Platforms where the hold stablecoins earn interest may become insolvent. Yeah. Many crypto platforms don't offer insurance on deposits like traditional banks do. Interest rates on stablecoins can be variable, subject to sudden changes. There are ways to hodl and earn up to 10% APY. The key features of this account is security, risk mitigation, transparency, client control. Wow, that seems good. Assets held in USDC took out on Lendon. Oh, this is the whose blog we're reading. I guess this is how you get new customers. They're collateralized with Bitcoin or ETH posted by borrowers. Ring fence. This means that as a client, you're only exposed to the credit risk of the counterparties that generate your yield. In the unlikely event of Lendon facing bankruptcy, your growth account will not be affected. Furthermore, Lendon only deals with the most reliable stablecoins. Okay. Okay, let's just look. Let's look at the this Lendon website. %8.5%. How do you generate interest then? I want to know. Tell me. If you have over 100,000, you get 8.5%. Okay. I mean, like 6.5% is pretty good. Like, you know, I'm getting 4.2% max with T-bills. Okay, so let's say like borrowing, Bitcoin-backed loans. Yeah, because I actually imagine something that's big in the crypto space is like actual like cash liquidity. Like if you want to go out in the real world, like I think like it would be hard to navigate if all of your value is held in like crypto and you need some cash. So like you could borrow against all your holdings to like at least get some cash. Role management. Simple seems way to grow your Bitcoin holdings. These are like loan. Dual cryptocurrency notes. Interesting. Interesting. Okay. Stablecoins are becoming essential in crypto space. They act as a bridge between the wild ups and downs of cryptocurrency, good old fiat currencies. What's fascinating is how much more profitable they can be than your average savings account. Yeah. When was this written? I hate when they don't say the published date. Okay. Yeah, market volatility isn't just a buzzword. While stablecoins aim for stability, they're not immune. Liquidity risk exists too. Some pools might get illiquid fast. Let's not forget regulatory risk, loss change could impact how we use these assets. Yeah, here's where it gets interesting. APY stands for annual percentage yield. It's basically annual return you get expect from your stablecoin if you park them in various yield generating platforms. Ours, okay. Let's say you throw $10,000 in platform with 10% APY that compounds monthly. By the end of the year, you walk away with over 1,000 just from the interest alone. Yeah, I mean I don't know. This article wasn't that helpful. Cool. Just read it. This was 2 months ago. Yeah. Yep. Yes, centralized risk. Yep. Let's see what this is on investing. Stablecoin yields can work in a high risk tolerance slice of your portfolio, but they're far from safe between platform risk, regulatory. Yeah, like it seems like more so it's like the platform risk, but let's look at Circle. Circle and Tether are like the big ones. Like what yield do we get with Circle? I thought USDC was like Coinbase or something, actually. Now I think about it. $19 chains. $100% by cash and highly liquid cash assets. Yeah, it's like a money market fund. That is what I kind of compared it to. I've seen it compared to. Obviously more risk. But do you get interest with USDC? USDC yield. I'd spell yield wrong all the time. Yeah, 4.1%. That's like just under Treasury, like T-bills, 4.2%. So, and I think though, like the lending thing is where you make like get higher yields, where you give your money, you like lend it to someone to use. We saw this Nexo. We were looking at that earlier. Interesting. All right. Yeah. Stable coins. Also, Ubisoft is oh, I literally just messaged you. Yeah, staking is different because staking you like give it to the blockchain to use for their stuff. Lending is you like someone like I think it's like you give loans up against your you use your tokens as collateral, your stablecoins as collateral, and then you loan out the money and you get higher interest on that. Yeah, staking or lending. But it seems like lending is where it's like it's you get more money, but it's riskier. Yeah, and JP Morgan actually has this stablecoin like company, or like they have a stablecoin in Connexus Digital Payments. But it seems like, yeah, you could get different yields depending on what you do with it, but just holding it, you get yields. Yeah, it seems like it's risky still, though. That's kind of like the key thing. Okay, what was we gonna look at? The oh yeah, that Ubisoft. Assassin's Creed Micro Ubisoft reverses gains as Tencent backed spin-off move. Ubisoft shares reversed course Friday after initially climbing as much as 11% earlier in the trading session. Volatile market action came upon Ubisoft's unveiled plans to form a new €4 billion gaming subsidy backed by Tencent. Chinese Tencent. Yeah. So we'll see. This subsidiary will include Ubisoft's best-known game brands, including Assassin's Creed, Far Cry, and Tom Clancy's Rainbow Six. Ubisoft shares initially jumped 11%. Yeah, the Game Gear said Thursday its newly formed unit would focus on building game ecosystems designed to be truly evergreen and multi-platform, i.e., online service. I just had such a big deja vu. Holy shit! I feel like I've read this and I've been in this situation. Okay, I'm gonna take a quick break, and then I need to use the restroom and get something to drink. Stable coins, and then we're gonna transition here to some games. Play with. Austin, Frosted Pop-Tart. Bro, I hate this shit, like, on all these crypto sites. Yeah, like, here we go. So, like, here's Venus. This is we looked at Venus earlier. So, staking. This is staking. .6%. There's 11%. This is staking too. Oh, here's Venus, yeah. Yeah, so supply API, borrow APY. Third highest. Hey, Brave, trust them. I actually want to sign up for the Brave Rewards partner program. Book flights and hotels with BAT. I actually had a reasonable amount of BAT. I don't know what happened to it. What accounts you have to use Uphold? I've never heard of Uphold. Okay, I'm gonna end on YouTube. We're gonna just be on Twitch here, and we're gonna switch to some gaming. Do some Battlefield, maybe some Minecraft. Yeah, we'll be back Monday, 9 a.m. on YouTube for some news, some tech news. Hope everyone has a good weekend. Come check out Twitch. Where is my Twitch? Yeah, come over to Twitch. Here's my Twitch. I sent that in Twitch, but YouTube too. All right, thanks YouTube. See you Monday, 9 a.m. Pacific.